Please note that the information on Retire Vivid referenced in this video is accurate as of May 30th, 2024. Changes to laws and regulations may make portions of this segment outdated and no longer relevant. Information presented is for educational purposes only and is not intended to provide investment, tax, or legal advice. Please see our full disclosure at the end of this video.
The United States was hurled from incredible wealth to dazed poverty in a single afternoon.
Today is Black Monday, the day the Dow dropped more than 500 points.
The stock market is now down 21%.
The market is not functioning properly.
That COVID-19 can be characterized as a pandemic.
This market is as volatile as you'll ever see.
The $95 billion to provide foreign aid to Ukraine, Israel, and Taiwan.
As you approach retirement, market volatility can heighten emotions, leaving you questioning the security of your retirement savings. From periods of uncertainty to unforeseen events you can't control. You can't control how events impact the market, but you can take steps to help mitigate market volatility.
Welcome to Retire Vivid. I'm Karen McCarty. That's Tommy Breitbach. And Tommy, I mean, market turbulence can make anyone nervous, especially during hard times. But, I think, we as people have an emotional attachment to money, which makes sense. And so when you're seeing something getting hurt, you want to save it, where in fact that might not be the best thing to do.
It's really not taking the immediate rash decision. It's keeping a long-term perspective. For those who are at or nearing retirement, maybe in retirement, you have saved hopefully for a long period of time. You've been through some market cycles. Hopefully you found the market comes back because it tends to do that over time. But it's very hard to keep a long-term perspective when things are happening, in real time, in that short time period.
Right. I mean, and I think the big thing is, as unnerving as they can be, they are normal. They're not fun, but they are normal. The question is how do you navigate through this? And so when you take a look, Tommy, and put things into perspective of the ups and downs of the market, I think this is really good to show because, I want you to dial in on this because, again, if you take a look at the S&P 500 with the market declines, even with up markets, you do see these downturns.
Yeah, it's very normal to experience a pullback, and sometimes pullbacks can be healthy. They can work off some of the excesses or renew buying power. But yeah, you look across going back to 1980, a 40-year period, 1980 to 2020, the market has experienced some level of down in each of those years, sometimes more than others. And by and large, you look across that chart, the market has ended up positive. And in those positive years, you still can get a pullback. So it's really important to, there's several studies out there that have shown, the feedback cycle or the frequency of feedback for those people that, are looking daily, looking monthly versus looking at that kind of annual to long-term perspective. You could be better off kind of ignoring some of that day-to-day, month-to-month noise, keeping that long-term perspective.
Well, that's exactly right, because it is really hard to sit still. I mean, that's the big thing, because you can't help but to think, Tommy, should I be doing something? Should I be doing something? Because if you're seeing something going down, what should I be doing? But I think the first thing is especially when you're navigating, market volatility, is try to resist the urge to sell based on recent downturns.
Well, I mean, everybody's heard the you buy low, sell high.
It's easier said than done.
That is the perfectly rational decision. Today,
Right.
We're talking about the emotional side of it.
Right.
People tend to find a level where they say, I can't take any more, I'm done. Oftentimes that is at or near the bottom. And so it's really important to, you sit down, you put a plan you feel comfortable with and a plan you can stick with, and not make those, interim decisions or the short-term kind of irrational moves.
Right, and also making, making these losses permanent, in terms of where it could be just temporary. But again, you're right, because it's just what I said earlier, we all have that emotional attachment to money. And so by having that plan, that will help navigate you through those tough times, right? How can we weather this storm, especially if you're living on your portfolio? Because a lot of our clients, they're pulling from their accounts, right? That's why we talk a lot about drawdown in terms of how much you pull from your portfolio, because we don't want something high where, for example, if the market's going down, you're taking the withdrawal, we're just hurting that account. So that's why you build those emergency funds and you have that plan, just like you said.
Right, and that gets into kind of the bucket approach, where if you are supplementing income with your portfolio, having, is that a year or 2 years kind of excess cash or some set aside cash available for those emergency large purchases, where you have the flexibility, portfolio's doing well, maybe it's going up, you can continue to take those withdrawals, but at the time it goes down, you're not accessing the funds for a large purchase or unexpected purchase.
Correct. The point is just to take a long-term view. What we need to do is be long-term focused, but also near-term aware. I think that's the big message here of what we're trying to tell people, because if you take a look at the markets throughout history, and you look at the big ones, because that's what we're trying to do with clients. We want to help, our goal is to try to navigate them, especially during those big falls. So let's take a look at this. This is actually pretty interesting. So if you go back to the 1990s, we had the collapse of USSR and also the Berlin Wall. And then you fast forward to the 2000s, we had the dot-com bubble that burst. I'm sure a lot of people remember that, but what they really remember is back in 2008.
And there were concerns about, is the financial market going to end or continue? You had the big housing bubble. And so, it's important looking at this chart, it took a number of years to kind of get back, but the market came back.
Right.
And continuing on. So if, there's always something you can find to be concerned about. I think it is very important to take that long-term view. Look at market history. The market tends to come back.
Right.
And again, getting back to that bucket approach or having that savings you can tap, in events like these, if those excess funds buy you that time to allow your portfolio to recover, that can go a long way towards just the retirement and income planning.
During the show, we're talking to a whole slew of people. They're all in different, in terms of parts of their life. The question is will the market come back for you? Right? Because again, your portfolio and the person that's helping you with it, a financial advisor is a coach. That's what we do for clients, especially during tough times. But I want to talk a little bit more about this, because when you take a look at, the past bear markets and you talk about them coming back, what is that average duration? I thought this was pretty interesting, Tommy. If you take a look at the average duration of a bull market, we're at 2,069 days compared to a bear market of 446 days. And I think that comes down to that tilting. And a little later, we're going to talk about potentially being defensive within your portfolio, but it really comes down to the strategy that you've implemented.
There is not a one size solution or one answer solution that fits everybody. Everybody's going to feel a little bit different about their money, have a different financial solution. It's really important to evaluate what you have going well for you, and also how you feel about investing prior to coming up with that plan. Because you make that quick decision or you can't take any more and you're out, you lock in losses at a low. So it's very important to, not only evaluate the numbers, but evaluate yourself and find that plan you can commit to.
I think that's where it comes down to your risk tolerance. And we're going to talk more about this. Make sure you stay with us. Again, we're talking about how to navigate market volatility. We'll be right with you after the break.
Do you have questions about your retirement plan, or do you want to know if you are on the right track? We are here to help. Simply go to retirevivid.com or call the number below to schedule a 15-minute retirement review. You can speak with us about taxes, Social Security, your 401k, or any quick retirement questions at no cost to you. We are here to make retirement vivid. Schedule your 15-minute retirement review today.
Welcome back. We're talking about navigating volatile markets. And so we just talked about how, market volatility is normal. And again, it really comes down to where you're at in your life in terms of investing. But we also need to talk about your risk tolerance and also your risk capacity, because Tommy, when it comes to investing, we already talked about the emotional attachment to money, the psychology of money, but it also comes down to how much can we stomach during times of uncertainty.
Right. And I like to break risk tolerance, risk capacity down into your ability and willingness. So ability is probably easier to measure. That's your financial situation. If you're in retirement, you have your sources of income, you have your asset level, you have your withdrawal rate, how all those pieces work together kind of determines how much ability you have to take risk. Willingness, on the flip side, is something that, you and I, we can't measure for how a client or a person feels about investing.
Right.
That is how much you can stomach. What do you like to see your portfolio do? Do you understand it's a long-term gain and you're willing to ride out some swings? Or is it something you don't want, that volatility? You're really looking to back it down. And so it's very important that you have all of your, all the financial numbers in place, and also, just your emotional evaluation and how you feel about investing plays a big part in how the retirement plan goes.
Right. It's also comes down to, if you're working with somebody, in terms of what their specialty is. For us, we work with people that are retired or close to retirement. They've been feeding their 401k plans. And then once you retire, what you have in there is what you're walking into retirement with you. And a lot of our clients are living on that, just like what we've talked about. But that's also where we want to know in terms of what you can take in. And I think that's also why, Tommy, we want to know your risk number. Meaning that, it's like a speed sign. So the faster you go, the more aggressive you are. So for example, let's just say that you come in and you go, you know what, I've never been happy with my portfolio. Okay, let's find out why. We find out that your capacity in terms of what you can tolerate is up to 70, okay? And your portfolio is at a 40. Well, no wonder you're not happy, because it's not getting up there with you. But if you flip it and you have a risk number of 40 and your portfolio is at a 70, you'll be happy during up markets, right? You won't be happy when we talked about, those downturns, because that really puts into perspective in terms of, hey, this is a wake-up call and I should reconsider how and what my strategy actually is.
Right. And from a long-term perspective, the second example you just mentioned, that's when mistakes are made.
Right.
Nobody's ever come in and said, I made too much money. This is too good.
It doesn't happen. No.
Everybody, you tend to figure out you're wrong at the bottom.
Right.
And that's when you can lock in those losses. You miss time in the market, you miss some of that recovery. And it's hard to come back from that. So you find out you're wrong at the bottom, typically not at the top. And so it's very important to evaluate where you are at individually and how you feel about your money.
Exactly. You mentioned the buckets, and we do that for clients. You got to have those reserves. Meaning, because the market will be volatile. It's not going to be great days forever. We've already showed people that. And so that's why you have those buckets where, you have short-term treasuries, maybe some money market funds to cover those expenses, especially when you're retired, or maybe that retirement income. I'm a big fan of where if we can have a bucket for that retirement income, where when the market's down, we're okay because we're living off of what we've done in the past. People like that. It's not good when you don't have a reserve, you go through that pain, and then you start selling because you're scared. I mean, that's why we talk about working with somebody that's done this before. And Tommy, another thing that I want to touch on is focus on time in the market, not trying to time the market.
You know, it's very, very hard. There's professionals that can't do it, try to do it unsuccessfully. You know, there have been some that have made some big calls at the right times. But over time, it is important to be, invested in a portfolio that fits you and kind of ignore some of that short-term noise.
That noise, that's a good point that you said that, because there's a lot of noise out there. In terms of my question too for viewers, especially for those that do it themselves, is where do you get your information from? Your research, if you would. Is it somebody from a talk show, you know what I'm saying, in terms of where they've never managed people's money before, or people that are managing people's money? I mean, that's what we are. We are a wealth management company. And again, people worked extremely hard for their money. I mean, but again, it's just setting the tone and putting a plan in place and sticking to it. And if you do that, you can find success in some areas to accomplish your overall investment needs.
Right, and and there will always be something to worry about.
Right.
There's always, a political situation or a geopolitical situation.
A pandemic.
Things we're not expecting that just pop up.
Right.
There's always something you can find to be worried about. It's just very important to keep that long-term view. And remember, the long-term happens over a long period of time. And that month-to-month, day-to-day can be volatile, but keeping perspective.
We also have a really good chart that we wanted to share with people in terms of, not, spending time in the market, not trying to time the market. Tommy, let's talk a little bit about that just to kind of, prove our point.
Yeah, and this was 5 individuals. They invested $2,000 annually over a 20-year period, and they worked down from timing of when they tried to time the market. So Peter, he was perfect. Found the low point.
Perfect timing.
we showed that chart, and there was a down point every year.
Sure.
Some drawdown. He found that bottom point every year.
He was perfect.
You can see what his account did.
Yep.
Ashley was not certain, knew she couldn't time anything, and so she invested on the first trading day of the year.
Okay.
Matthew said, well, I don't know if I want it all in at one time, so he's going to go and average his $2,000 monthly to get his $2,000 limit. Rose was terrible. She found... Over that 20-year period, she found the high point of every year.
Yep.
And Larry didn't want to do anything, and so invested in a T-bill or a cash-like substitute. Was just afraid to be in the market. So you can see the large discrepancy, between the first 4 and Larry.
Yep.
There is some variation among the first 4. Obviously, if you're perfect at market timing, it's going to be better. But just time in the market, not timing the market, is important to long-term success.
That's right. And you know what, too? I mean, everybody has a different, and that's okay. Your peace of mind goes a long way. And so, being in the market isn't for everybody. I mean, it's just not. There's some people that just want to be in a CD or some type of fixed instrument, and that's fine. If that gives you peace of mind, who am I to tell somebody different? But there's also people that, hey, like with our clients, they want to make a decent rate of return, and they just don't want to lose a lot, and they want to keep up with inflation. I mean, that's what our people are looking for. And there's some, especially if they're younger, that want to be more aggressive, as you should be, because you're building wealth. But as you near retirement, you have built your wealth, and you're moving into that distribution phase rather than the accumulation phase of retirement. It's kind of that go-go year, right? We always have fun with that.
Go-go, slow-go, no-go.
That's right. Go-go, slow go, and no go, right? Well, I like the go-go. But that's also why, Tommy, you need to have a diversified portfolio. You can't just be in one stock or one company. You need to find balance in terms of what you're trying to accomplish with your money.
Yeah, you want things that work at different periods of time. If you get too far to one side or too concentrated in a certain market or sector or stock, it can work well for a long period of time, and then, you get a headline risk or, a significant drawdown affecting all the same companies, and your portfolio returns will reflect that. So it's important to, find a balance in there and look for different types of instruments, whether that's, stocks or international or bonds or corporate bonds or treasuries, CDs, money market, fixed products, like you mentioned. It's finding a balance and finding things that work at different times, just so you can attempt to smooth out some of that volatility.
Right, because every single product or security is doing something different for you in terms of what you're trying to accomplish. I think the whole point is your portfolio. What is the makeup of your plan? And you know what? We meet with a lot of people. The question is, I mean, do you know the makeup of your plan, or you know, are you just trusting in somebody to do that? I mean, you don't want blind trust, but you need to know what you're in, especially because today's segment is on market volatility.
Yeah, and it should be it should be a back and forth relationship. It should be goals communicated both ways.
Yep.
And just, you know, we mentioned selling at the bottom or deciding you can't take any more. And that's when mistakes are typically made. So it's just really important that you are on the same page, you have that plan, and it's one that you can commit to and stick with into and through retirement.
Well, this is good. So next we're going to be talking about potentially being defensive. Maybe that we'll be talking about rebalancing as well too. So make sure you stay with us. We have more on how to navigate volatile markets. There are other considerations when it comes to navigating market volatility. And so that comes down to, which we've talked about, being defensive. We talked about the buckets, cash equivalents, treasuries, that sort of thing. Rebalancing, withdrawal rates. I mean, I want to touch on this, Tommy, as we wrap up this episode.
Yeah, there's a lot of considerations in there. And it's really important to remember in volatile markets, losses and gains are not created equal. The smaller the loss, the easier it is to get the gain back, obviously. But if you have a 10% loss, it takes you 11% to get it back.
That's right.
If you lose going higher, if you lose a third of your portfolio, it takes a 50% return to get back. If you lose half the portfolio, you have to double it to get back to even. So that's why it's so important to have your bucket approach, have your plan, and stay committed to a plan. Give your portfolio time to come back, and the bigger the losses, the longer it takes.
Well, I think that also comes down to where you can look at tilting, right? So let's say you have your initial stance, let's say that's a moderate stance. And so you may have the ability too, where it's like, hey, if equities are going to be doing well, because equities have over time outperformed the bond market, but you tilt back and forth. Right, so you have your original stance, and as equities in the stock market is doing well, you can tilt more towards equities. But when it's not doing so well, get back to your original stance, and if it's getting worse, tilt maybe moderately conservative. But you're kind of moving back and forth in terms of an investment plan.
Yeah, there can be times where equities are more appealing, or stocks may make more sense. But going back to the time in the market versus timing the market, it's really hard to have perfect timing or know when to be in or know when to be all in, all out. And so It's important to have an allocation you feel good with. If you want to let it run a little bit, you can do that. If it's something it's run too much, that's where we talk about rebalancing. It's really important. You can take some of the winners, pare it back, get you back to where your desired allocation was. But just really a portfolio management process.
Yeah, right. I mean, I'm glad you mentioned that, because rebalancing is important, because you're going to have some, especially when you have some investments or securities that are doing well, it's overweighting your ship, if you would. So you need to get back into balance. And I believe that's important to do. The other thing too, as we've talked about rebalancing and then the bucket approach, is also the withdrawal rate. I want to touch on this, Tommy, because in terms of, you mentioned this plenty of times during this episode, timing of losses and also changing the withdrawal rate. We have some examples. I want to go through those.
Two investors, $1 million each, looking at a 5% withdrawal rate increase for inflation. But the first investor retired at a poor time. Market experienced a 15% decline during the first 2 years. Second investor had a good 9-year run in the market prior to 15% declines in years 10 and 11. And you can see from the example just how much the timing of losses can impact portfolios, especially when you're looking at withdrawals from those portfolios.
Oh, for sure. I mean, because like we talked about, a lot of retirees are pulling from their portfolio. That's why we always monitor what is your withdrawal rate, meaning what are you pulling out of the account? Because again, we don't want to see your retirement doing this over the years. We want you to be able to enjoy retirement and also seeing your account move forward, always pushing that needle forward. That's a big one. Now let's move on to changing your withdrawal rate. So let's use that example.
These two individuals both had $1 million, both lost 15% in the first 2 years. And you can see the impact of changing that withdrawal rate. So portfolios after the first 2 years growing at 6% a year, in the first person was able to reduce the withdrawal rate to 2%. Second person needed that 4% withdrawal rate. And you can see the difference. It took 11 and a half years for investor one to get back to even.
Look at that.
Investor two, it took them 28 years.
That's unbelievable.
And so we've talked about the bucket approach, but if you are able to minimize some of those withdrawals in the event of a decline, this example kind of highlights just the impact of withdrawal rates on portfolios coupled with losses.
That's such a great example there, because again, I mean, that withdrawal rate's important because people are living longer, Tommy, and one of the number one fears of retirees is running out of money. And I mean, that's why we're doing this show. I mean, if you want to do this yourself, go do it. I mean, that's okay. But there's some people that just are not comfortable doing it. So we always talk about, hey, find somebody that you trust. Somebody you trust, and also, do you believe in the philosophy of how they manage money, and also what type of retirement plan are they setting up for you? And that's why we do this 15-minute retirement review.
Right, and it becomes not just the numbers, the X's and O's of the plan. It is a relationship built on trust that you're both working towards the same goal. Not blind trust, but trust that you are working towards that same goal.
Right.
And also a little bit of the coaching aspect. We've talked about market volatility, but talking clients over the long term, just being long term focused
and near term aware. That about sums it up right there. So what a great episode. I mean, again, this is something we're always going to be dealing with. And so again, folks, if you ever have questions, whether it's about your 401k or maybe your retirement plan in general, that again is why we do that 15-minute retirement review. We are truly here to help you. I hope you learned something today, or at least got a little nugget out of what we talked about. Remember, we are on every weekend helping you get retirement ready. We'll catch you next time right here on Retire Vivid.
Cameron McCarty and Tommy Breitbach are investment advisor representatives of Vivid Wealth Management, a SEC-registered investment advisor located in Des Moines, Iowa. Investment advisory services are offered through Vivid Wealth Management, LLC. Insurance products and services are offered through Vivid Tax and Wealth Advisors, and individually licensed and appointed agents. Tax planning and preparation services are offered through Vivid Tax Center, LLC. The preceding entities are affiliated. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Case studies and examples presented are hypothetical and used to demonstrate a concept. These studies do not represent actual clients or results. Similar or even positive results cannot be guaranteed. None of the entities above are affiliated or endorsed by the Social Security Administration or any government agency. Information expressed does not take into account your specific situation or objectives, and is not intended to provide investment, tax, or legal advice. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. Investments involve risk and, unless otherwise stated, are not guaranteed.